guys, I'm here to share with you about my stock account update. Today my stock account has made a loss of $40. US stocks fell more than 200 points. What is the US debt ceiling? What will be the consequences of breaking the ceiling? So in my account today, I've made a loss of 0.06%. And right now the net asset of my account is $71,120.27. Today, United Natural Gas made a loss of 0.16% to $6.39. Market generally closed mixed. Dow Jones Industrial Average closed down 0.66%. Nasdaq Composite closed up 0.18%. And S&P 500 closed down 0.17%. Today, internet content and internet retail all closed higher due to the rise of Google, and it has made a gain of more than 3%. Banking industry and the semiconductors closed down with more than 1%. Concern about regional banks continue to grow, with the regional bank stocks falling on Thursday, with PacWest down 22%, Zion down 4.5%, and Credit Union down 6.8%. Media giant Disney closed down 8.7% after the company posted disappointing second quarter results. While the price increase strategy helped its streaming division narrow its losses, it hit the company's users' growth hard. Disney also announced that it will take out $1.5 billion to $1.8 billion in impairment charges as it removes more content from its streaming platform. CFRA Research Ken Leon, head of equity research, said this is a major adjustment and they improve efficiency when planning content. That is big news. Leon said, that is basically saying we're not going to put everything into direct streaming of the future. We're looking at where to get the best return to drive free cash flow. Investors had other important inflation data on Thursday. Labor Department reported that the producer price index rose 2.3% in April from a year earlier, compared with a 2.4% expected rise and a 2.7% rise last month. US PPI rose 0.2% in April month-to-month, compared with a 0.3% rise forecast from a 0.5% decline last month. Data released on Wednesday shows that the US Consumer Price Index fell below 5% for its first time in 2 years earlier in April, paving the way for the Fed's suspension of a year-long cycle of interest rate hikes. The Consumer Price Index released yesterday has begun to show signs of slowing. Although still high, transport delays, shortages, and other logistics problems have significantly pushed up commodity prices in 2021 and the first half of 2022. But the gradual easing of these problems have been a key force in slowing inflation. The PPI, which measures wholesale prices, has been consistently slowing year over year. The Fed is now closely monitoring service prices for signs of significantly waning inflationary pressures. Last week, the Fed raised interest rates to above 5% for the first time since 2007. Current market pricing, according to Chicago Mercantile Exchange's FedWatch tool, suggests a 95% chance that a Fed will keep rates at its current level in June. Minneapolis Fed President Neil Kashkari said Thursday that the U.S. price pressures remain too high. The Fed's 2% inflation target will not change in the near future. Once we reduce inflation to 2%, we can consider changing the target. Inflation has fallen, but still well above the 2% target, Kashkari said in an event in Michigan on Thursday. We've seen wage growth slow nationwide, but very uneven. Kashkari said has a vote on the Federal Open Market Committee this year. The Fed raised interest rates by 25 basis points earlier this month, moving them to a 5% to 5.25% range and suggesting that they may be ready to pause the tightening cycle. Keeping interest rates at their current highs for some time will allow officials to assess the impact of interest rate hikes and banking pressures on the economy, while still trying to slow inflation by cooling demand. The Labor Department also reported that initial claims for state jobless benefits were 264,000 in the week ended April 6, the highest since the week ended October 30, 2021, expected 245,000 versus 242,000 last. The market is also focusing on the U.S. debt ceiling. On May 11th, Treasury Secretary Janet Yellen said she fears that the United States will default if Congress failed to reach an agreement to raise the debt ceiling, and suggested that the U.S. should find a new system to determine fiscal policy. Asked about the debt ceiling at the G7 Hiroshima summit in Japan, Ms. Yellen said, "Personally, I think we should find a different system to determine fiscal policy." She proposed that the Congress could abolish the debt ceiling completely, or that the president could raise the debt ceiling, and then lawmakers decide whether to veto the decision. What is the U.S. debt ceiling? What will be the consequences of breaking the ceiling? U.S. President Joe Biden said he may have to attend the G7 summit online, saying it depends on his process of negotiating with congressional leaders on the U.S. debt ceiling. While Biden stressed that he's still very concerned about the G7 summit, it is clear that the U.S. debt issue is now the most important thing on his agenda. On May 11th, U.S. Treasury Secretary Janet Yellen attended a group of 7 finance ministers meeting in Niigata. She said before the meeting, the federal debt is hit the current $31.4 trillion legal debt ceiling. If the Congress does not raise the debt ceiling, the global economy will face recession and the other terrible consequences. It will weaken the economic leadership. The U.S. debt default will seriously hurt the U.S. economy and the world, and I think everyone should think this is unthinkable. Serious partisan divisions within Congress over the debt ceiling and the federal spending issues. Democrats want to raise the debt ceiling without attaching any strings, while Republicans demand spending cuts as condition for raising the debt ceiling. The Wall Street Journal reported, "What is America's debt ceiling? What will happen if the two parties fail to reach an agreement on raising the debt ceiling? Which group will be the most affected in this financial storm?" The right way to open the debt ceiling. The debt ceiling is the amount of national debt the Treasury can afford. Was the concept first introduced by Congress in 1917 to more easily fund mobilization in World War I. The U.S. debt ceiling has been raised far more than a century, 78 times since 1960. To understand the debt ceiling, the Brookings Institution must take it clear. Raising the debt ceiling is not related to raising government spending, but to paying for policymakers' past choices. Voters, even some legislators, often mistakenly believe that raising the debt ceiling is creating more deficit. But in fact, ongoing debt limit debate is about whether the Congress should authorize the government to borrow to pay spending Congress has already authorized. In early May, Ms. Yellen noted that if the Congress does not raise the debt ceiling, the U.S. government could be unable to pay all of its bills on time. According to U.S. Wall Street Journal, as soon as June 1st, but Ms. Yellen also said that the Treasury's latest forecast remained uncertain, and that perhaps the Treasury world would still be able to pay its bills in the week starting June. The latest forecast from the think tank Bipartisan Policy Center suggests the government could start failing to pay some bills on time at sometime between early June and early August. U.S. Treasury Secretary Janet Yellen vision on China file photo. If debt is kept, the Treasury uses several accounting methods to delay liquidation dates, which typically last a few months. If the U.S. government cannot borrow money to help cover all due bills, it will have to suspend payments of its payments, withhold or cut military federal wages, or delay interest rate payments, which constitute a default. Members of Congress from both parties, business groups, and Wall Street firms have all warned the prospect of federal government defaults, citing disastrous consequences for financial markets and the U.S. economy. A loss of confidence could trigger a massive sell-off in U.S. Treasuries, which in turn leads to broader financial disruption. In addition, other U.S. debt payments such as unpaid Social Security benefits, if not made on time, could also damage the economy. In 2011, for example, the U.S. reached a crisis point of near default on public debt, and the Treasury was unable to pay certain benefits for days, sending the credit rating downgrade, the stock market tumbling, and higher borrowing costs. Who is the most vulnerable under the deadlock? With the Congress failing to make progress on the debt ceiling deal, Moody's Analytics warned that it will be disastrous for jobs in the country if U.S. failed to properly resolve the debt ceiling violations. CNN, citing a May 10th forecast, says that while most states will be hit hard by debt ceiling violations, their economic pain points vary. This will be disproportionately affect the large concentrations of federal workers or states that work more on government funding. This includes Washington, D.C., the areas or dependent on federal agencies such as national laboratories or military base. Meanwhile, the unemployment rate in District of Columbia, California, and Ohio will soar to nearly double digits. Michigan's unemployment rate will rise 10.8% from the current 4.1%. Other states said that it will be significantly affected are those that rely on federal spending and the aerospace industry, such as Virginia, Connecticut, Kansas, and Washington. All these states which rely on tourism, including Arizona, Florida, and Nevada, as well as auto-dependent states like Michigan and South Carolina, will experience a sharp wave of unemployment, Moody's said. Looking for breaking the debt ceiling, some larger states would each lose hundreds of thousands of jobs. Mark Zandi, chief economist at Moody's Analytics, wrote in the report that violations are more likely to be short-term than long-term, even though the possibility of a long-term confrontation is no longer zero. To emphasize the seriousness of the situation, Biden acknowledged this week for the first time that he was considering using the 14th Amendment as a means to avoid the debt ceiling standoff. But he doubted that whether it would work. It will face legal challenges and the ceiling would be reached without a delay. Its aides said Monday that the amendment was unlikely to be used, although the idea could be explored after the crisis passes, so the situation would not repeat. In response to Republicans' additional demands, Biden said Republicans' reluctance to cleanly raise the debt ceiling was economy that undermines the U.S. economy. Inside the White House, Democratic aides remain to believe that they have the upper hand in the negotiations and will reach a deal to raise the debt ceiling, according to political news site Politico. The White House has expressed its openness to the cuts, but only if that ceiling is raised. Biden is scheduled to meet again with McCarthy, Charles Schumer, Senate Minority Leader Mitch McConnell, and House Minority Leader John Jeffries on Tuesday. Until then, White House staff and aides to 4 congressional leaders will continue discussions, officials said. White House aides believe the political stance of the debate remains on their side, but recent polls suggest both sides will be blamed. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.